guys, we got this great clip from one of our long content videos. Don't forget to hit the subscribe button. Enjoy. Now let's get into the same house and buying the house subject to the mortgage that already exists. First, let me define what that means. Instead of assuming the mortgage and coming in and qualifying and talking to the bank and jumping through all of the hoops, you simply say, listen, Mr. Seller, I'm going to step into your shoes. Your name, you're still going to be on the hook for it, but I'm going to put my money where my mouth is and I'm going to start making the payments month after month after month. And you're not going to tell the bank anything. You're going to just buy the house subject to the existing mortgage. So when you buy a house with a mortgage that you're buying subject to, you purchase the property like it says, subject to the existing mortgage. The original borrower, he remains responsible for that mortgage. And so he's requiring and he's relying on you as the person who's stepping in and buying the house subject to make the payments on his behalf. And if you don't do that, you're going to screw up his credit. You're going to cause him to have a foreclosure on his name. He's got some liability. So just keep that in mind. And when you're doing this stuff, you need to do it with integrity and do what you say you're going to do and pay these bills. The pros of buying it subject to, it's really, really fast, right? Like, so you can come in, you can find a motivated seller who's got a mortgage that he took out 10 months ago, and now he's 3 months behind and he's in pre-foreclosure. He hasn't paid the bank in 3 months. He's on his way to a foreclosure sale. He's going to lose the house because he lost his job or he got a divorce or his wife died. Who knows why, but he's got some motivation. He's behind on his payments, and you come in and you say, listen, I'm going to bring your loan current and I'm going to take over the mortgage subject to. I'm not going to relieve you of your responsibility, but I'm going to put my money where my mouth is and I'm going to buy that property. And by doing that, it's an easy transaction. It's a quick transaction. You get the benefit of taking over the low interest rate loan. He gets the benefit of not having to make the next payment and getting the payments that he's behind paid on his behalf. That'll improve his credit. That'll help him avoid foreclosure. There's all kinds of good that comes from it. You get to take advantage of the low interest rate. I think I've already said this, but there's just a historically low interest rate right now, going back even 8 or 10 months. Things were at sub 3 levels for a 30-year fixed loan. That was just absurd. That's practically free money. Actually, not practically free money. It's better than free money. If you had known about how bad the inflation was going to get, you would have borrowed as much money as you could at 3% interest rates, because the inflation has gone up to what they're admitting to, 6.5%, 7%. And if you're sharp, you know that it's really probably closer to 15 or 20% inflation. Another pro to taking over a mortgage subject to is that you get the credit for the time that the person has been in the loan. So they got their mortgage for a 30-year fixed or a 15-year fixed 10 months ago, 2 years ago, 4 years ago, whatever it is, and you now come in and step into their shoes, start making their payments on their 30-year fixed loan, and so you've got the benefit of those 3 or 4 years that they're paying. Now you're paying off that loan much quicker. It's far superior to going and getting a new loan and then having 30 years to go. You avoid the closing costs, the doc stamps, you avoid all kinds of costs by buying something subject to. Here are some cons to buying the subject to. So the bank, this is the big one, and this is the one that everybody in the world is afraid of. This is the boogeyman, right? This is the, oh my God, I can't do this because the bank's going to use their due on sale clause and they're going to call the loan due and they're going to force me to pay them off. So that has been a truth for 25 years. I've been in this business for 25 years. We've bought houses on occasion where we took things subject to. And never one time has the bank ever really called the loan due, especially if you're on time and you're making the mortgage payments. And so that is a con, but I want to put it out there that this isn't professional advice. I'm just some guy on the internet who buys some real estate, and I'm no lawyer and I'm no accountant. So get yourself professionals who guide you and tell you this, but I'm encouraging you that you really don't have to worry about this boogeyman. It's so unlikely that they're going to call it due. And even if they did call it due, you'll have time to deal with it and negotiate with them. So that's a con, though, that there is something called a due on sale clause. It's true. In just about every mortgage that's written, it says, hey, borrower, you can't do this. You can't sell this house subject to. And so you need to know that going in, that there is that risk. Some other cons and some other risks is that you have no control over the terms of the mortgage, right? So if you're buying subject to, you're buying subject to a mortgage that someone else took out. And if it's got bad terms or a bad interest rate, you're having to pay on those terms and on that interest rate. And so you'll need to be sure that you know what those things are before you take over someone's mortgage. Hey guys, thanks for watching that. Subscribe to our channel, watch this next, and then also check out the pinned content for more great content, guys. God bless.